Oil just hit $90 a barrel, and that should terrify you. The last two times oil prices spiked like this, in 2008 and again in 2022, it was followed by economic pain that hit ordinary people the hardest. Right now, conflict in the Middle East is choking off one of the world's most critical shipping lanes, the Strait of Hormuz, and the ripple effects are already showing up at the gas pump, the grocery store, and in your investment portfolio. Today we're going to break down exactly what's happening, why it matters for your money, and what you can do about it before it's too late.
Here's what you need to understand. Nearly 20% of the world's oil supply passes through a single narrow waterway, the Strait of Hormuz, right between Iran and Oman. It's barely 21 miles wide at its narrowest point. When tensions escalate in the Middle East, this bottleneck becomes a choke point for the entire global economy, and that's exactly what's happening right now. In March 2026, S&P Global revised its forecast, projecting Brent crude to average $90 per barrel this month, up dramatically from the $60 baseline we had just weeks ago. That's a 50% spike in the cost of the single most important commodity on Earth. Now, oil doesn't just power your car. It's embedded in everything: the plastic in your phone, the fertilizer that grows your food, the fuel that ships every product you buy. When oil prices surge, it creates a cascading wave of inflation that touches every corner of the economy.
But here's what makes 2026 different from past oil shocks, and potentially more dangerous. The economy was already on shaky ground before oil prices spiked. According to the Pew Research Center, 72% of Americans now have a negative view of the economy. That's nearly 3 out of 4 people who feel things are getting worse, not better. Consumer confidence is crumbling. On top of that, the Federal Reserve is stuck between a rock and a hard place. Inflation was already running at 2.8%, above their 2% target. Now, with energy prices surging, the Fed faces an impossible choice: cut interest rates to support a weakening job market and risk even higher inflation, or keep rates elevated and risk pushing the economy into recession. The Conference Board projects U.S. growth will slow to just 1.5% by the end of this year, barely above stagnation. And there's another red flag that has Wall Street veterans on edge. The Shiller CAPE ratio, a measure of how expensive the stock market is relative to its historical earnings, is hovering around 40. The last time it was this high? Right before the dot-com bubble burst in the year 2000. Warren Buffett's own indicator, which compares total stock market value to GDP, is also flashing a warning that hasn't been this loud in over.
So what does all of this actually mean for you, the person watching this right now? First, expect higher prices at the pump. Every $10 increase in oil prices translates to roughly 25 cents more per gallon of gasoline. If you're driving to work every day, that's hundreds of extra dollars a year just to get to your job. Second, groceries are going up. Food prices are heavily tied to energy costs, from the diesel that powers farm equipment to the fuel that transports produce across the country. When oil is expensive, everything at the supermarket gets more expensive too. Third, your investments could take a hit. When the Fed can't cut rates because of inflation, it removes the safety net that has propped up stock prices for years. If corporate earnings start declining because consumers are spending less, the stock market, which is already overvalued by historical standards, could see a significant correction. And fourth, if you're carrying debt, credit cards, auto loans, a variable rate mortgage, higher for longer interest rates mean you're paying more every single month. The average American household now carries over $10,000 in credit card debt at an average interest rate above 20%. That's a financial time bomb in a rising rate environment.
Now here's the good news. You're not powerless. There are concrete steps you can take right now to protect yourself. Step 1. Build an emergency fund. If you don't already have 3 to 6 months of expenses saved in a high-yield savings account, make that your #1 priority. In a recession, job losses happen fast, and having cash on hand is your best insurance policy. Step 2. Pay down high-interest debt aggressively. Every dollar you throw at a 20% credit card is a guaranteed 20% return. No stock market investment can promise you that. Step 3. Don't panic sell your investments. History shows that investors who sell during a downturn almost always lock in losses. The S&P 500 has recovered from every single crash in history. Every one. The key is staying invested and not buying at the top out of FOMO. Step 4. Consider diversifying into defensive assets. Treasury bonds, dividend-paying stocks in sectors like utilities and healthcare, and commodities like gold have historically performed better during economic uncertainty. And step 5, watch the data, not the headlines. The media profits from fear. What matters is the actual economic data, employment numbers, inflation reports, and the Fed's actions. Let the numbers guide your decisions, not the noise. The world economy is entering a turbulent stretch. Oil prices, inflation, and an overvalued stock market are colliding at the same time, and the people who come out ahead will be the ones who prepared, not the ones who panicked. This is the Money Lens, and now you can see it clearly.